Hey guys, welcome back to the channel. Today's video, we're going to be looking at the average 401k balances by age. Now we're going to see exactly how your savings stack up, guys. It's something to really be cognizant of when you go through and you're putting money into the 401k. You have to think about one of the absolute superpowers that we have, guys, which is compounding interest. So the younger that you are, the more you're putting away early into your 401k, which we will look at those percentages for the contributions, the more it is going to really impact the long-term savings. So what's happening is, as we see a younger generation, they put a little bit into 401ks. As you start getting into the 30s and 40s, the income not only increases, but the contribution amount also increases. When you start getting into the 50s and 60s, getting in that retirement age, they are putting a lot more into 401ks, but you do not have the time. That is really, I feel like, when a lot of people are figuring out exactly what they want to do, figuring out now is the time, I'm getting ready to retirement, spend the next couple years before retiring really stacking up that 401k with what you can. But again, you are losing the compounding interest that you can see. Now, one thing to note, guys, Social Security Administration said retirement benefits for Social Security, so SSI benefits, are roughly replacing 40% of the worker's wage. That is right, guys. If you're making $100,000 a year, all of a sudden, boom, you are living paycheck to paycheck. You go from a $100,000 a year to a fixed income on Social Security. It replaces roughly 40% of an average worker's wage, which means could you survive on $40,000? For a majority of people, that is an absolute no. Now, most Americans are not saving enough money. We've seen this for years. We've heard it for years. That is really what we wanted to look at. So according to average 401k balances, there are $9.6 trillion in assets. That is right, guys. Almost $10 trillion, which accounts for 41 million workers in the workplace through 401k plans. Now, another thing is this does not take into account any other retirement plans. So if you have money in an IRA, if you have money in a savings account, if you have money invested elsewhere, even just within the stock market, this is not taken into account. This is literally just the 401k plans that are held. Now, 20-somethings, 20 to 29, average 401k balance is around 10,000. So when you think about the average going from a 20 to a 29-year-old, guys, this is really the time you're either one, starting to finish school, the 21, 22, 23 age, enrolled in school, starting to find your footing, starting to work a full-time job. This is the time that balances are going to be relatively low, but this is the time for the biggest impact. If you start off in your 20-somethings putting away 15% of your pay, even though it might be a little bit more difficult, the average contribution rates of someone 20 to 29 is 7%. Now, if your employer offers a match, anything of that nature, you can actually get, a lot more contribution. So if you're putting in 7, let's say they're matching 4, guys, that is a really good contribution. But let's say theoretically you're putting in 15, they're matching 4, you are going to be light years ahead of most other individuals if you're starting to save at that level right out of the gate. And also, if you're putting away 15% at the beginning, you're not going to notice the difference when you get pay raises, if there's incentives tied to it, anything of that nature, guys. If you literally stick with that 15% rate, it is going to make a big difference. When you think of 20-something, 65, you're retiring. If you have 45 years of compounding interest at a 15% rate, if you work for all of those years, you are going to have a massive amount of money when it comes to your 401k. Then we get into the 30s to 90s. Now, the average 401k balance in a age 30 to 39 is $38K. That is right, guys, $38,000. So now you've went through your 20s, you finished those out, you're in your 30s, even, mid 30s, late 30s. 30 to 39 average balance is $38,000, which is incredibly low. Contribution rate does go up a little bit higher. It goes up to 8%. That is right, guys. Contribution rate went from that 7%, we're up to the 8% when you get into your 30s, which again is a very, very far cry from the 15% that we really want to get in there. And if you listen to Dave Ramsey, if you listen to a lot of financial investors, financial advisors, really getting that 15% mark is critical. not including the match. You can't say, okay, well, I'm putting in 10, my employer's putting in 5. That way I do net that 15%. Nope, we want 15%. Anything over that is going to be completely icing on the cake when it comes to savings and when it comes to, again, that compounding interest. Now we move into the 40s to the 49, guys. Average 401k balance reaches 93K. That is right, guys. In the 40s, we are just shy of $100,000. However, the big thing to note with this age group, the 40 to 49, which is exactly where I am, they are still only contributing 8% of the income, guys. That is right. The contribution rate for this level is very, very low. When you're looking to retire, you know, if you're 40 and you're looking at 65, 67, you have 25, 27 years. This is the time, again, the compounding interest could have a massive effect. Even though you're in your 40s already, it is the time to bump that contribution rate up to 15%. Now, when you get into the 50s, the average 401k is 160K. So even looking between the 40s to the 50s, the average goes up by about $67,000, which isn't a lot when you consider almost 10 years of additional growth in there. But the contribution rate goes up to 10%. That is right, guys. We are seeing the rise from the 8% to the 10% when you start getting into the 50-somethings, because I feel like for a majority of people, this is where it becomes reality. When you're in your 40s, when you're in your 50s, getting ready for retirement really becomes a reality, when theoretically it should be in your 20s and 30s, guys. But when you start getting into the 50s, you start putting away a higher contribution limit. When you get into the 60s, now these are reaching the retirement age. Right now, I believe with Social Security, you can claim at 62. I believe it is 67 now for full benefits, but the average 401k balances go to 182,000. That is right, guys. From the 50s to the 60s, then the 60s to the 70s, the balance is 22,000 higher. That is it. That doesn't really increase that much when you're starting to get there, because of course a lot of people at this age are looking to get into retirement and have started withdrawing some of the money from the 401k, depending on what they do have. Now, contribution for this age bracket does go up to 11%. So again, a little bit higher in this age bracket, but still not to the 15 that we are really shooting for. And then when you get into the 70s, the 70 to 79, average 401k balance goes down to 171, which means that they're taking money already actively out of that 401k. And those balances they are taking out of the 401k are the 60% that is not supplemented from that Social Security. Contribution level, if you're still working in the 70s, is around 12%. But again, for a majority of people, they might have a part-time job. They might have something that kind of offset the Social Security, where if you would have started saving in the 20s and 30s, you would not have to work during retirement, because you would have your 60% supplemented with that compounding interest that we really have built. So how much should you save? Again, general rule of thumb, guys, by age 30, you should have 1 time your average salary. By 40, you should have 3 times. 50, you should have 6 times. By age 60, you should have 8 times your salary when you're working. And by age 67, the full retirement age, you should have 10 times your salary. So think about that, guys. So if you're hitting 65, 10 times your salary, you should be sitting on, if you're making $75,000 a year, you should be sitting on $750,000 saved. That is the concrete, that is the fundamentals, that is where you want to get. There's also tried and true, the 80% rule, making sure you have 80% of the pre-retirement salary when you go. Again, I don't like that. I like the 15% rule, that you just put that 15% in. So what is the reality, guys? So when you look at reality, when people hit retirement age, it is around $163,000 they have saved. That is going to last them not as long as they think in retirement. They're averaging 5 to 7 years before that money out of that 401k is gone. If the average balance is $163,000, this is because when you go from full-time work and then you move into the retirement, you realize you have a ton of time. Time is usually associated with money, short of sitting at home, not really doing much of anything. Is if you're looking to do things, if you're looking to travel, if you're looking to, cross things off that bucket list, you're going to spend a lot more money when it comes to retirement. than when you were actually working, because 40, 50, 60 hours of your normal work week were taken up by the job itself. So here's some tips, guys, to really save for retirement. Number one, know your 9 to 5. Make sure that it is something that you love to do and develop that budget. We've talked about the budget an exorbitant amount of times at this point, guys. You really have to know where your money is going. The budgets make a huge, huge difference. Number two, make sure you maximize your contributions. If they offer a match, you need to be doing your match. Again, we are shooting for and looking for putting 15% into that IRA or that 401k, just making sure that you are getting that match. If not, you're leaving money on the table, which is a horrible, horrible thing to do, because your employer is getting off scot-free without giving you that money. Investing more aggressively earlier. So this again is another thing that we really see when you're in your 20s, when you're in your 30s. That is the time to aggressively invest, guys. Not only putting money in, but the investments itself. You want to be in more of a high aggressive plan because you do have a lot of years to recover. So worst case scenario, you have something that really bottoms out. You have a lot of years to still make up differences, make up those balances again, maybe not being as risky with it, but overall, you have to make sure that you know what you're doing. Another tip, look at your fees. Guys, there are a ton of investments just like M1 Finance that I use. There's actually a link right down below for a referral. But look at the fees that they charge, guys. If you're getting charged 1%, even around 1%, it can equal up to almost 20% of your full retirement plan if you are just literally getting eaten up by fees, which a lot of people do. A lot of investment advisors have monthly fees. Some of them have annual fees. Some of them have percentage-based fees. So definitely making sure that you are aware of the fees that are there. So what is a solid 401k balance for a 30-year-old? 30-year-old guys should have around $40,000 to $45,000 when you hit 30. So you figure, you start working 16, 18, maybe 22 if you're just doing the school route. You have 8 years to accumulate essentially $40,000, which doesn't seem incredibly hard. Again, if you're putting away that 15%, I don't think you're going to have any problem hitting that number, because it is not too crazy high by the time you hit 30. So the bottom line, guys, the more that you save for retirement, the better off you're going to be. Trust me, I am learning from really experience, from seeing a lot of people who are in retirement or approaching their retirement age, not only having money in retirement, money in IRAs, 401ks, but also controlling the debt, getting the debt paid down and off. If you're looking to go into retirement and you still have a lot of bills, you have a lot of credit card bills, you have a full mortgage, it is super, super difficult to make the transition monetary wise if you're sitting on a lot of debt. So, all right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.